Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at AMC Entertainment.
If you find our talks useful, please consider subscribe, like, and comment underneath. We also have a special 14-day trial link below in the description for StockOracle.
Yeah, StockOracle is the AI-aided stock research platform we use to help structure our analysis.
And just a quick heads up, that link is an affiliate link, so the channel may earn a commission if you use it, but it comes at no extra cost to you.
Right, and we always like to remind everyone that StockOracle is a research tool.
Yeah.
So it is not financial advice, it's not a trading signal service, and it doesn't provide real-time market data.
Exactly. Plus, AI insights and valuation estimates can sometimes be incomplete or just flat out wrong. So always verify the important facts yourself before making any moves.
For sure. Always do your own homework.
Okay, so getting into AMC today, there's this really fascinating illusion when you go watch a massive Hollywood blockbuster.
Oh, I love this analogy. It's so true.
Right. You are sitting there in the dark, completely immersed in this beautiful, seamless world on the screen. The heroes, the explosions, the music, it all just feels incredibly solid.
It feels like it was always meant to look that perfect. You don't see the seams.
Exactly. But if you were to walk onto that actual movie set while they were filming, you wouldn't see a seamless world at all. You would see a chaotic, stressful mess.
Oh, yeah. Miles of tangled cables everywhere.
Yeah, fake facades held up by 2x4s, stressed out production accountants tracking every single dollar, and just an incredible amount of literal duct tape barely keeping the whole operation from collapsing.
The front of the house looks like magic, but the back of the house is pure survival mode.
And that massive gap between the beautiful illusion on the screen and the gritty, messy reality behind the scenes is exactly what we are looking at today.
It really is. When you look at the foundational data in this mid-August financial snapshot, you immediately see a company trapped between two completely conflicting realities.
Right. We are trying to figure out if this highly volatile, heavily discussed stock is actually engineering a genuine business turnaround, or if it is just riding another wave of retail hype.
Well, you have this genuinely improving operational momentum, meaning the actual business of showing movies is gaining traction. But that momentum is constantly at war with a deeply scarred balance sheet.
And that balance sheet threatens to just drag the whole thing under. So let's start with the operational momentum, because our research actually opens with some surprisingly heavy-hitting top-line numbers.
Yeah, the revenue figures are kind of wild. For the second quarter of 2026, AMC pulled in $1.597 billion in revenue.
Wow, almost $1.6 billion in a single quarter.
Yep, and if you zoom out to the first 6 months of 2026 as a whole, revenue hit $2.642 billion. That is a 16.9% growth year over year.
That is a massive influx of cash coming through the box office. People are definitely buying tickets.
They are. But while top-line revenue is great, the most critical fundamental shift highlighted in the numbers isn't just the gross revenue, it is the operating cash flow.
Okay, let's unpack that. Because operating cash flow is just the actual cash generated by the company's day-to-day operations, right?
Yeah, exactly. Selling tickets, moving popcorn, paying the staff. It strips out all the financial engineering and just looks purely at the core business engine.
And how does that engine look right now?
Surprisingly good. For the first 6 months of 2026, AMC's operating cash flow swung from a negative $231.6 million in the prior year to a positive $106.9 million.
Wait, a swing of over $300 million.
Yeah. And going from a massive negative to a positive 100+ million is literally the difference between bleeding out and breathing on your own.
I mean, when a highly leveraged company is burning cash from operations, every single day is just a countdown clock to bankruptcy, right?
Right, unless management can raise more outside capital.
Mm-hmm.
But when you turn operating cash flow positive, you stop the bleeding at the source. The core engine is finally sustaining itself.
Okay, so the core engine is running better, and the data highlights a trailing 12-month gross margin of over 67%. Which honestly makes sense when you think about theater economics.
Oh, absolutely. The markup on popcorn and soda is notoriously astronomical.
Yeah, the marginal cost of letting one more person into a theater that is already playing a movie is basically zero. But looking at these numbers, I have a major structural problem with the bullish thesis here.
Let's hear it. What are you seeing?
Well, if revenue is up almost 17% and the operating cash flow is sitting at a positive $106.9 million, why is the trailing 12-month net margin still sitting at a negative 10.59%?
That is the big question.
I mean, why did they still post a $128.5 million net loss for the first half of the year? It feels like looking at a restaurant that has a line out the door every single night.
Right, they're packed.
Yeah, they make an incredible gross margin on every meal they serve. But the owner decided to rent a billion-dollar gold-plated building, so it doesn't matter how many profitable meals they sell.
The rent on the building just eats every single cent of profit before the owner actually sees a dime.
Exactly. That restaurant scenario feels like it captures the exact dynamic playing out on AMC's balance sheet right now.
It's a perfect analogy. The core business of showing movies is doing its job, but the corporate shell built around that business is suffocating it. The reality check in this data is severe.
How bad are we talking?
Well, at the end of June 2026, AMC reported total liabilities of $9.496 billion. That completely dwarfs their total assets, which sit at $8.044 billion.
Oh, wow. Which results in the metric the analysis calls negative stockholders' equity, and they have that to the tune of $1.453 billion.
Yeah, and we should pause on that term, because it sounds like boring accounting jargon, but it is incredibly practical.
Right. If AMC were to liquidate today, I mean, if they sold every theater, every projector, every single popcorn machine, and used all that money to pay off their liabilities, they would still be in the hole for $1.4 billion.
Exactly. They technically earn more than the entirety of the company is worth on paper. And the anchor dragging that equity into negative territory is the debt load.
The $3.8 billion in total long-term debt.
Yep. So going back to your restaurant analogy, the operational engine is generating cash, but a massive portion of that cash has to be routed immediately just to service the interest on that mountain of debt.
It leaves almost nothing to reinvest in upgrading theaters or, competing with streaming tech or weathering any future box office slumps.
Right. And if the math is that brutal and the company is functionally operating with negative equity, then the stock shouldn't be up over 80% in a few months.
That's the crazy part. The only way that happens is if the broader market is pricing in a completely different future, or just looking at a narrative that ignores the current balance sheet entirely.
The market is absolutely pricing in a shifting narrative. And that narrative, according to the August 2026 reporting, is that big screens are currently beating streaming.
Which is a massive psychological pivot for investors who spent the last, 5 years assuming theaters were just going the way of the dinosaur.
Right. But the data shows IMAX, Cinemark, and AMC stock have all been climbing as blockbuster movies fill theaters. Meanwhile, Netflix has actually seen some declines in the same window.
And the domestic box office for 2026 is actually tracking toward a $10 billion mark. So the sector tailwind is real. People are leaving their couches.
They really are. And it is fascinating to watch how institutional analysts are struggling to reconcile this box office surge against AMC's terrible balance sheet.
Because it creates a massive divergence in price targets, right? Which
Yeah.
tells you a lot about how broken standard financial models get when they encounter a stock like this.
It really does. We have Texas Capital upgrading AMC to a buy with a $3.0 target. Fintel is reporting a price target jump to 2.89.
But then you look at Citi, and they remain deeply bearish with a 1.80 target. That is a wild spread for a stock currently trading around $2.50.
It is a massive spread. And it happens because these institutions are weighting different parts of the financial model. Texas Capital is likely looking at that positive operating cash flow and the $10 billion box office projection.
So they are weighting the momentum.
Exactly. They're modeling a future where AMC generates enough cash to slowly chip away at the debt. But Citi, on the other hand, is likely looking at the terminal value of the company and that $3.8 billion debt wall.
Right, and just concluding that the math simply doesn't work out long term no matter how many tickets they sell this summer.
Precisely. But there is another layer to this price action, and it goes beyond institutional models. The analysis highlights a surge in retail optimism being driven by a rumor on a platform called U.com.
Oh, the S&P upgrade rumor?
Yeah. The rumor claims that S&P has given AMC a credit upgrade to a B- rating because of their recent debt reduction efforts.
And this is where we have to explicitly look at the mechanics of market sentiment, because that S&P upgrade is completely unconfirmed by any primary filing or official press release in the data we have.
None at all. Yet it is heavily driving trading volume, which is incredibly dangerous if you are holding shares.
Extremely dangerous. Because in today's market, algorithmic trading bots scrape social media and news aggregators for sentiment keywords. If an unconfirmed rumor about a credit upgrade goes viral, those algorithms just start buying instantly.
They drive the price up in milliseconds.
Exactly. And then retail traders see the price moving, assume the rumor is true, and jump in. But if the reality check hits and S&P comes out and says, we never upgraded them, the algorithms will dump the stock faster than a human can blink.
And you are left holding a massive loss based on ghost data. You are pricing a rumor as if it is a mathematical certainty.
Which is why we need to look at how the stock is actually behaving on the chart.
Yeah.
What does the technical structure tell us?
Well, as of mid-August 2026, the stock closed at 2.50. It is showing incredible medium-term momentum. It is sitting well above its 50-day simple moving average of 2.26 and well above its 200-day simple moving average of 1.78.
Let's break down why those moving averages actually matter, because they aren't just arbitrary lines on a chart.
Right.
The 200-day average, sitting at 1.78, essentially represents the average cost basis for long-term holders over the last year. Since the current price of 2.50 is way above that, it means the long-term trend is decisively bullish.
And the 50-day average at 2.26 shows the medium-term traders are also in the green. It creates these strong psychological support levels.
It does. And the raw return is staggering. The data shows a 13-week return of 87.97%, nearly 88% in roughly 3 months.
However, our snapshot notes it recently dipped below the 20-day moving average, which indicates the short-term momentum is stalling out a bit. And we have to talk about the beta, which sits at 2.22.
Right, the volatility amplifier. In plain English, the market baseline is a beta of 1. So if the broader S&P 500 goes up or down 1%, a stock with a beta of 1 moves about 1%.
But with a beta of 2.22, AMC is historically reacting more than twice as violently to market swings.
It's not a stable investment, it is a leveraged roller coaster.
It really is.
Yeah.
And the primary mechanism driving the downside of that roller coaster is the elephant in the room. We have to talk about equity dilution.
Yeah, the stock is up 88% recently, but we have to examine how management is actually keeping the lights on. Dilution is one of those concepts that gets thrown around a lot, but understanding the actual mechanics of it is vital here.
It is the whole ballgame.
Imagine an island economy that uses rare shells as currency. There are only 1,000 shells in circulation on the whole island, and you own 10 of them. So you hold 1% of the island's wealth.
Okay, I follow you.
But then the island chief realizes they owe a massive debt to a trading ship from the mainland. So the chief simply goes to the beach, collects 5,000 new shells, and introduces them into the economy to pay the ship.
Wow. So the total amount of currency on the island just expanded massively.
Exactly. You still hold your 10 shells, nobody took them from you. But because there are now 6,000 shells in circulation instead of 1,000, the purchasing power of your 10 shells just plummeted.
Your slice of the pie was heavily diluted. And the numbers in our research show AMC has been collecting a lot of shells on the beach lately.
The scale of the dilution is staggering.
Yeah.
And they are doing it through 3 distinct mechanisms, right?
Yeah. First, we have 105.3 million shares issued through at-the-market, or ATM, offerings. This is where the company simply bleeds new shares directly into the daily trading volume to raise cash.
The silent dilution.
Right. Then you have 95.25 million shares from direct offerings, which are usually blocks of shares sold directly to institutions, often at a slight discount to the market price.
Okay.
And finally, the largest chunk, 142.1 million shares issued from debt conversions.
The debt conversions are the really interesting part of this financial engineering. This is when AMC owes cash to a lender, but instead of paying them back, they negotiate a swap.
Exactly. AMC says, we will print millions of new shares of our stock and give them to you, and we'll consider the debt settled.
And you have to ask why a massive institutional creditor would accept highly volatile stock instead of just demanding the cash they are owed.
Usually it's because the creditor looks at the balance sheet, sees that $1.4 billion in negative stockholders' equity, and realizes the cash simply isn't there.
Right. If they force the issue, AMC goes into bankruptcy restructuring, and the creditor might get pennies on the dollar years from now.
But by taking the shares, the creditor gets immediate liquidity. They can turn around and sell those newly printed shares into the retail market the next day.
So management is actively managing the capital structure. They are paying down that massive $3.8 billion debt load, which is completely necessary for corporate survival, but they're doing it by constantly inflating the share supply.
Which is the fundamental catch here. Even if the box office hits $10 billion, and even if the cash flow keeps improving, the stock price might struggle to actually climb.
Because there is this massive, continuous oversupply of shares flooding the market. Every time the price spikes, management uses it as an opportunity to print more shares and pay down more debt.
It creates a hard ceiling on the stock. And this brings us to a fascinating quirk in the news sentiment section of the data. It highlights how the broader market ecosystem actually categorizes AMC.
Oh, this was crazy. Among the top 5 material news stories populating the AMC feed in August, one of them was an article titled, "Hertz jumps 30%, Bears sweat as short squeeze continues."
An article about a completely different company in a completely different industry.
Precisely. And this happens because algorithmic trading systems and news aggregators don't read context. They just read market structure and volatility profiles.
Right. The algorithms have grouped AMC into a specific basket of distressed, high short interest momentum plays.
To the quants and the machines, AMC isn't a movie theater company at all. It is just a volatility ticker with a high beta grouped right alongside companies like Hertz that have similar trading dynamics.
That perfectly illustrates the dual identity of this stock. On one hand, you have retail investors trading on the romance of the movies, the $10 billion box office, and the emotional narrative of beating the Wall Street shorts.
And on the other hand, you have institutional algorithms trading it purely as a distressed momentum vehicle, completely detached from whether a new superhero movie does well on opening weekend.
It is wild. So we need to pull all of this data together. The revenue growth, suffocating debt, the massive dilution, and the algorithmic trading environment into a coherent final verdict based on this August 2026 snapshot.
Where does the overall investment rating land?
The quantitative assessment provided by the data gives AMC a bullish score of 5 out of 10. It is a strictly neutral stance.
So dead center.
Dead center. And the long-term view depends almost entirely on 2 catalysts actually materializing. First, the upcoming Q3 earnings need to prove that the positive operating cash flow wasn't just a one-quarter fluke.
Right.
And second, the back half of the 2026 movie slate has to actually deliver on that $10 billion expectation.
Because the upside of the improving operational engine is perfectly counterbalanced by the massive debt and the constant looming threat of further share dilution.
Which means if you're looking at this stock, you really have to factor in market efficiency. That 88% run-up over the last 13 weeks means the market has almost certainly already priced in the good news.
The revenue beat in Q2. It is reflected in that 2.50 price. The positive cash flow swing, priced in. The general enthusiasm for the summer box office, also priced in.
And what might not be fully priced in yet is the lagging long-term impact of all those hundreds of millions of new shares diluting the underlying value.
Or, more dangerously, the risk of the holiday box office falling short. Because if the movie slate underperforms and revenue dips, the turnaround thesis weakens instantly. But the $3.8 billion in debt doesn't weaken.
No, the debt is permanent until it is paid.
Which leaves us with a final, slightly uncomfortable dynamic to think about. When you look at the entirety of this analysis, the debt conversions, the at-the-market offerings, the reliance on social sentiment, you realize that AMC is currently surviving by continually selling pieces of itself.
They've weaponized a highly loyal retail investor base, constantly issuing new shares into that buying pressure to pay off old institutional debts.
It is brilliant financial engineering out of pure necessity. Management is doing exactly what they have to do to keep the company out of bankruptcy court.
But the lingering question is, what happens if that engine stalls? If the blockbuster movie slate stumbles? Or if those retail investors finally tire of having their shares diluted and their island currency devalued? What happens when the financial engineering runs out of steam?
Yeah. If you are looking at this today, you have to ask yourself, are you actually investing in the magic of the movies and a sustainable turnaround? Or are you just playing a high-stakes game of musical chairs with an ever-expanding supply of stock, hoping the music doesn't stop while you are the one left holding the shares?
That is the multi-billion-dollar question. And until we see those Q3 numbers, and until we verify if that credit upgrade rumor holds any water, the answer remains completely hidden behind the curtain.
So the next time you sit in a theater enjoying that seamless, magical illusion on the screen, take a second to think about the chaotic, highly leveraged reality holding up the business behind it. Keep your eyes on the actual filings, understand the mechanics of what you are analyzing, and don't get caught looking the wrong way.
Well said. Just a strictly neutral 5 out of 10 rating for now.
If you found our talks useful today, please consider subscribe, like, and comment underneath.
And don't forget to check out that special 14-day trial link below in the description for Stock Oracle to get more of these AI-aided insights.
Exactly. Just remember to always verify the facts for yourself. We will catch you on the next one.